Hi everyone, this is Paul Stewart here from Elite Wealth Property Consulting. We're in the business of helping buyers of UK property investments to remove corporate taxes on rent or corporate taxes on property development profits. And we're often asked whether this is any form of tax avoidance and whether somebody should be worried about using the tax structure. So this video is all about tax avoidance. And more importantly, it's why the genuinely diverse exempt unit trust is definitely not tax avoidance. We're using statutory structures. So, how to avoid tax avoidance? Quick video, not going into too much detail, but I'm hoping it'll reassure you in terms of the structure itself and the underlying way it's treated by HMRC in the United Kingdom. So, first and most important thing is, how can a tax structure not be tax avoidance? Because you're ending up with paying no tax at all on rent and no tax at all on property profits. So how can that not be tax avoidance? So let's quickly look at what tax avoidance is and how it compares with what we do, which are statutory structures. So first thing is, if HMRC have got different rates of tax and some planning is able to move you from a higher rate, for example, 45% tax, down to a lower rate, say 10%, that's tax which is being saved. So is there a tax advantage in the work that's being done? And tax avoidance is basically people looking for the tax advantage. So turning something from income into a capital gain, because in the United Kingdom, the rate of tax is different. That's tax avoidance. And whether it's workable or non-workable is down to how it's interpreted. One thing I must say is tax evasion is utterly illegal and we don't get involved in such things. And in fact, we don't get involved in tax avoidance either. We're not involved in showing you how to turn something from income into a gain. Because what we don't want is tax avoidance to be rejected by HMRC. And if you think back about the history of newspaper reports, you've got various people like comedians who are on telly and they did some tax avoidance and HMRC rejected it and they end up having to pay enormous penalties and it's very, very costly. That's something we do not get involved in. We use statutory arrangements and no tax is being avoided. So therefore, there's no opportunity for HMRC to turn around and reject things. So I'll give you one statutory example. If you have a pension scheme and it's an approved pension scheme and it's got a reference number from HMRC, any of the investments inside it will not pay tax, whether that is income or capital. Doesn't matter. There's no tax avoidance. It's a statutory example. Pension schemes do not pay tax on their investments. Another thing is an exempt unit trust. Once you've been approved by HMRC as an exempt unit trust, you yourself as a structure do not pay any corporate taxes because the taxes are levied upon the holder of the units. So that's a statutory example. The unit trust itself pays no corporate taxes. However, the holder of the units will be subject to whatever tax they pay. And in this case, if it's a pension that holds the units, we've already said that a pension is exempt. If you combine the two, you have a statutory exemption. All of the investments in the unit trust are exempt because it's a unit trust that's been approved, and all of the income and gains inside the pension are also exempt. So let's have a little look at the detail. First of all, we have to start off with a pension. If you're running a UK business, that pension may well be a SAS, which is a small self-administered scheme. If you're based outside of the UK and you've got personal money, you may well be using a QNUPS, which is a qualifying non-UK pension scheme. The key thing is you start off with a pension of either a UK or an offshore variety, and the pension scheme buys units in a unit trust. So that's what's happening. Pension scheme is buying units, making an investment. So first thing is, if it's a SAS, it'll have a pension scheme's tax reference number. And that basically is a number issued by HMRC through Section 150 of the Finance Act 2004. It's a statutory stamp upon the structure to say that it will pay no tax on returns made on investments. So whatever happens to those units in terms of growth, there'll be no tax to pay. The next thing is the genuinely diverse exempt unit trust itself has an HMRC reference number, and under Regulation 6.4 of the Unauthorised Unit Trusts Tax Regulations 2013, bit of a mouthful, but it's a certificate issued by HMRC with a reference number to say that the genuinely diverse exempt unit trust itself is exempt from corporate taxes. So, if you have a pension, whether that's a SAS or a QNUPS, investing in a genuinely diverse exempt unit trust, there'll be no UK tax to pay on any of the investments held. So it's not tax avoidance, not tax evasion. It's not something which is going to be looked at by the revenue and overturned by the revenue, because no tax is actually being avoided. Both of these things are allowed legitimately to operate without any tax. So let's have a look. Once you've bought your units in your unit trust, what does the unit trust do? Well, historically, if a unit trust is buying property, it would put, for example, property number 1 into limited company number 1, property number 2 into limited company number 2, and so on and so forth. And as far as unit trusts are concerned, each of those limited companies will be operating on behalf of the unit trust, and therefore each of those limited companies would pay no corporate tax. Perfectly a normal thing for unit trusts to do, to earmark properties inside particular limited companies. It might be that there's a limited company that operates the properties in Manchester and another one operates the properties that are in Portsmouth. So nothing unusual, nothing strange in terms of a unit trust having multiple companies underneath the one banner. So let's have a little look at the taxation of the exempt unit trust and the pension working together. So we have a pension scheme that's exempt from tax. We have units being purchased, so any gain on those units that the pension receives will be exempt from tax. The unit trust establishes a limited company, and that limited company buys a property, and that property generates rent. So where is the tax trigger for that rent? Well, the first thing is, if we look at the limited company itself, it will pay no corporate tax. So whatever profit that company makes, it will actually be deemed to be part of the exempt unit trust. And because it's part of the exempt unit trust, there'll be no tax to pay. So it doesn't matter whether it's buying and selling property, developing property, renting property. Quite legitimately, this is how these things work. There's no tax avoidance, there's no tax evasion. It's literally that's how unit trusts work. And of course, any growth in those units falls inside a pension scheme, and of course, as we already know, pension schemes are exempt from paying any taxes on gains or profits made. So that's why and how we can end up with a structure where you can run the property investment decisions inside a limited company on behalf of the unit trust, and all of the value in all the property that you buy, in all of the rent that you receive, all of that value goes into the growth of your units inside the pension scheme, whether that's a SAS or a QNUPS. So you will legitimately have no UK tax to pay on any of those property arrangements. Again, as I keep saying, not tax avoidance, it's just statutory. Pensions by statute don't pay tax on investment returns. Exempt unit trusts, again, are exempted from paying corporate taxes because a unit trust, the taxes are moved up to the holder of the units. So I hope that that's of some benefit to you. Our job is to look at the different pension arrangements, and if we're looking at a SAS, it's a UK pension. You may well live in the UAE, or you may well live anywhere in the world, but still have a UK-based company. You may have UK-based pension schemes from previous employment. Those can all be moved into a SAS, and the SAS can buy units in the unit trust. If, however, you don't have the opportunity of getting involved with a UK-based pension, absolutely nothing stopping you from establishing a QNUPS, which is a qualifying non-UK pension scheme. It's an offshore pension, nothing to do with the UK, but it's been given tax approval by HMRC in the UK. And basically, your tax residency will determine any tax that's paid. So if you're building value inside, for example, a QNUPS, and you live in the UAE and you're taking the money from that particular pension arrangement, there'll be no tax. And of course, whilst you're getting involved in property investments, there'll be no tax to pay on the rent. There'll be no tax to pay on any gains you make on selling property. In fact, I think the only tax you'll be paying is stamp duty when you're purchasing properties. But for now, this is just a quick run through to demonstrate that we're talking about statutory arrangements rather than tax avoidance or tax planning. And that's really, really, really important that you understand the differences. Statutory means it just does what it says on the tin. Tax avoidance involves involves looking at structures, looking at trying to persuade the revenue that something is not what it really is, or you're using a loophole. None of this involves loopholes. This is just the way that pensions and unit trusts have operated, certainly for longer than I've been in the business, which is about 35 years. So there we go. Quick run through. I'm Paul Stewart. Company is Elite Wealth Property Consulting. The email address is there, paul@elitewealthproperty.com. And please don't hesitate to get in touch. It'd be nice to hear from you and see how we can help.